You're not gonna like this number. 61% of Americans invest in the stock market, more than any other major country in the world. And yet, more than 70% of retail and DIY investors lose money. So why do we keep coming back? What makes us think that we can beat the odds? We'd be better off playing blackjack or something. Turns out the odds have always been against us, and I don't think that anybody really has any idea why. But the answer is actually in this chart. When the 1929 recession happened, which, was large enough to kind of break the world, only about 3% of Americans or 10% of US households owned any stocks at all. That still crashed the economy. Like some lessons we learned back then, which I'm gonna get back to, but we carried on. And then in the 1950s, at the start of the baby boom, only 4% of people owned stocks. So how did we get to today? There was a pivotal moment in that chart, and it's right around here.
I don't know if you're aware of this enough. We are in the middle of the biggest bull market of our generation.
From 1982 through 1987, the Dow index grew 300%, but this decade also saw one of the biggest accidents in American legislation ever. I'm gonna call it a $9 trillion oopsie. Because you see, before the 1980s, your pension, your retirement money would come from the company that you worked for. At the time, people had these 30-year tenures working for the same company, so it was the company's responsibility to cover their pensions along with their government social security pension. And this system was called a defined benefit pension system. So as a founder, Slidebean is a tech startup. It's not just a YouTube channel, in case you didn't know, but being responsible for my employees' pensions sounds like a nightmare. Like companies would have to set and manage these funds, which worked, but also sometimes not because they were irresponsible on how they invested the money. Also, companies fail. So what happens then? Like overall, this feels like a terrible burden, distraction from running a business. But anyway, that's just how it worked. Now, in 1978, this tiny change in the tax code was made that would start a revolution, very much by accident, because the idea was that if you had, for example, a salary bonus because you had a great quarter of performance, you could put that into your retirement account, and if you did, you wouldn't have to pay taxes on it until later, until you got that money out, which is neat, right?
You have earned for you and your fellow refiners a 5-minute music dance experience.
Well, nobody worried too much about this section or exception to the code. They didn't even bother to name it. It was just section 401k. Also, this was your money. Like, it wasn't in a company pension fund. It was yours. Like, it moved with you if you found another job. A self-managed account. Well, a few months later, there was some confusion. What money can you put into your 401k? Just the bonuses? Could you put more of your salary? So the IRS had to come out and clarify that not just bonuses could go to your 401k, you could put in part of your salary too. And then companies saw this huge opportunity to get rid of this headache, because instead of the hassle of having to create and manage a pension fund for their employees, they'd just switch the benefit to matching their 401k contribution. It's easier for the companies, it's more transparent to the employees. And so by 1990, the US had 19 million 401k participants, $380 billion in assets, and the old school pension system was disappearing fast. If you're an American, you maybe don't know how things work outside the US. Like a typical retiree household in the US will see about 50% of their income coming from Social Security pension and from their 401ks. But that's not how it works in the rest of the world. In many European countries, the government pension is a 70% or more of a pensioner's income, and the 401k equivalent, which is mostly a supplementary income, is not the primary pillar. But hey, Americans, your future's in your hands. You can manage those funds yourself. What are you going to do with them? You know you don't have the financial knowledge to pick stocks yourself, right? You're going to go to a professional. Wall Street suddenly saw this fresh new batch of assets under management, fresh new money to gamble with and collect those sweet management fees. And over the next 20 years, the number of Americans investing in stocks skyrocketed. And there was also another bull run happening at the same time with internet stocks. This is the 90s, remember? So all this stuff looked really tempting and exciting.
AOL, Yahoo, Amazon.
It has really created a very strong brand awareness.
Internet stocks drove a powerful surge on Wall Street today.
The internet is so revolutionary that the usual rules for valuing a stock.
Another note, Americans, like, all of your news are about stocks all the time. Like, I get why you care so much about them. I just want you to know that that's not how news looks in the rest of the world. Anyway, by the year 2000, 60% of Americans were directly or indirectly invested in the stock market. Even if you're not investing directly, your pension fund depended on the performance of the stock market, so you'd pay attention. And why not maybe choose to make an extra bet on that boo.com company that you've been following. America is the land of entrepreneurs, the land of opportunity, and you can partake in the country's economic boom, and you don't trust the bank or the Wall Street guy anymore. You want to make your own decisions, and you've done your research about that company, you understand the internet, so let's fucking go.
This closing bell might as well have been an alarm. So savage was the
We're
sell.
now 6 3/4 points above fair value.
Nothing short of breathtaking, a points drop never before seen on the US markets.
But the dot-com bubble was just an oopsie. Like, the real shit hitting the fan wake-up call was 8 years later.
This is going to be one of the watershed days in financial market history.
1 in 4 houses has already been repossessed by the banks.
7.5% unemployment and a record number of bank failures.
Getting kicked out of your house.
Not just a house. Means so much to all of us.
Trillions of dollars have evaporated from those accounts that have become the prime source of retirement funds for a majority of American workers.
This should have been a purge just for Wall Street investors, but when 65% of the population is invested in the stock market as well, and the stock market plummets, someone needs to save the economy. Even the people who played it safe, who put their 401ks on mutual funds or trustworthy institutions, suffered, sometimes losing their entire pension savings.
Everything that we worked for is down the drain.
I started my retirement plan when I was 19 years old. That's almost 40 years ago. The government allowed one man to take it away.
The percentage of Americans who bet on the stock market decreased after the 2009 crisis, but it still stayed well above 50%. I don't believe any other country gambles its economy on stocks like the US does. Not just your disposable income or a percentage of your savings, but your retirement money too. But there is a much darker connection, and I think that Americans have been blind to it. Now, before I tell you about that, I wanted to take a moment to thank NordPass for helping us fund today's explainer. NordPass was created by the experts behind NordVPN to make businesses compliant, to let your team store passwords, passkeys, credit card details, and other sensitive information securely, and to collaborate on it with the rest of your team, or with your customers, or with your collaborators. The average number of password per employee used for business-related accounts is 87. People waste 11 hours per year just resetting passwords. It's more than a full workday lost. So you need to give your password manager a go. So we migrated our old password manager into NordPass with a simple export-import function, and everybody hit the ground running in minutes. For businesses, NordPass also features a data breach scanner, which gives you live alerts if any of your corporate data appears on the dark net. On average, it takes companies 204 days to detect any breach, so, it's better to stay alerted than have a financial or operational loss. So we partnered with NordPass to bring you a 3-month free trial on NordPass for Business and a 20% off on their 2-year plan. You can try it by going to nordpass.com/Slidebean and using the code Slidebean at signup. You can also just scan this QR code and hit the ground running. You'll level up your business security, you'll save a lot of money, and you'll help our channel in the process. Around that time, middle of the 2000s, this office building in the middle of San Jose was booming, because this was the epicenter of all the illegal, legal sportsbook activity in the country. The US has always had this love-hate relationship with sports betting, ever since horse racing. This got worse in 1949 when Nevada legalized sportsbooks in Las Vegas, but the government was quick to ban moving funds across state lines to fund those bets. And that stopped legal bets, but created this whole economy of illegal bets all over the country. If you're a real Yankees fan and you watch every single game and you stay on top of their team performance, you can make, I'd say, very educated guesses, predictions about the outcome of a game. Arguably more educated than your bet on the .com company. Definitely enough to put your money where your mouth is, but things started to get a little bit out of hand, and this dude rained on everyone's party.
This is a red letter day in baseball. Rose voluntarily accepted a lifetime ban betting on baseball while he was the manager of the Reds.
One of the game's greatest players has engaged in a variety of acts which have stained the game.
Did you bet on baseball? Yes, I did. That was my mistake. Not coming clean a lot earlier.
Because how can you bet on something when you control the outcome? That has to be super illegal, right? So Congress mega banned sports betting in the US just a couple of years after Pete Rose's case. But these offshore sports books figure out a few loopholes to continue operating. Because for example, they have these .eu domains and stay away from US soil, but still take most of their bets from US customers. Every other English-speaking Costa Rican millennial did their time at a call center or a sports book coming out of college or during college.
I did my waiting in Azkaban!
And this was good business. As of 2011, US customers placed $150 billion in illegal bets every year. A story for another day. Let me know if you want me to talk about it. But what these companies also did was pave the way for digital and gamified gambling. You know, a user experience that's light and fun and that makes easy upsells. Of course, in 2018, the Supreme Court struck down the ban on sportsbooks, which I'm sure is unrelated to that sweet potential tax revenue from all those off-the-book bets. But after sportsbooks were legalized in America again, business boomed. In the 2 to 3 years after sports betting was legalized, net investments by household in the stock market fell by 14%. But there is an even more obvious smoking gun. 2020, the world shuts down, sports are canceled, and therefore sports betting is canceled. And then you're bored, you're locked in your house, you have nothing to bet on. What do?
I made 4,010 minutes day trading NASDAQ. Let me show you how.
Few pips below the top of the flag. That's a winner.
Here's how you can make $100 a day trading Forex.
Day trading skyrocketed when the pandemic started. Charles Schwab saw 600,000 new broker accounts created in the first quarter of 2020. Remember, this is a month before anybody got any stimulus checks or anything. This is just people who are bored at home.
Bored in a house and I'm in a house bored. Bored in a house.
By the time those arrived, it was clear where the money was going. Thousands of fresh new dollars printed, nowhere to spend them on because you're locked at home in this crazy booming stock market. Robinhood added 7 million monthly active users between 2019 and 2021. Now let's get something out of the way. One thing is betting on a company's long-term future outcome, or maybe on the S&P 500, the index of a bunch of different companies. Historically, that number has always grown, and you are guaranteed to stay at least on trend with the entire economy. In those cases, you can use your own cash, the money that you have, to buy the stocks that your cash can afford and be on your way. Now, a whole other game is betting on a meme stock, not because you did your research and like the stock.
As for me, I like the stock.
But because it's trending on Wall Street Bets. Oh, but you can also make a leveraged trade. Basically put down 10% of the money that you would need to make the trade and then borrow the other 90%. You can 10x your bets, but also 10x your losses. Like leveraged trading is what literally caused the 1929 crisis. And back then, only 3% of the population was in the stock market. But that was over 100 years ago. Another ballgame is to day trade. Day trades are not looking at long-term outcomes or macroeconomic data. They're watching minute-to-minute price movements, short-term trends, and momentum indicators to profit from those swings. They're less concerned with the company's future fundamentals, are much more concerned with the immediate psychology of the market, trying to capitalize on small and rapid fluctuations before the closing bell. And that's not even the best paying bet. You can buy calls. In a call, you pay a small fee for the option, but not the obligation, to buy a stock at a given price, say $100. So if the stock goes to $105, you can execute your calls and profit on the $5 difference. So you're betting against someone else's bet to see who's right, and that's how this dude turns $700,000 into $33 million, at least for a while. And of course, you can do this from the comfort of your phone, monitor it in real time, and brag to your internet friends at Wall Street Bets. Tell me, please, how that isn't the same as gambling. Like, from a psychological standpoint, gambling can be defined as placing
something of value on an event of uncertain outcomes in the hopes of winning or earning a larger reward.
The only difference is that one has been normalized as investing because wealthy people do it and because thousands of internet gurus are talking about it. Now, of course, there is one fundamental difference, which is that over time, gambling will always yield a negative result. That's just what the stats are. While in theory, and if you invest responsibly, investing should have positive outcomes. But that's not the high that these investors or these speculators are seeking. A 2024 study found that for every dollar that a household puts on sports betting, those households reduce their stock investments by about $2. It's literally just transferring one bet, one addiction from one betting platform to the other. It's the same money, and it's satisfying the same dopamine craving in your brain. Day trading and speculation doesn't rely on research, it doesn't rely on long-term goals, it just relies on chance and timing. Take, for example, a group of Gen Zs. This is another study. If you separate those that invest in the stock market from those who don't, 61% of the stock market investors also gamble. And then out of the group that's not in the stock market, only 29% of them gamble. Those who gamble are also more likely to invest in options, in derivatives, in NFTs, crypto, I'm sure meme coins, and they're more likely to use leveraged trades, which statistically have always performed worse than non-leveraged trades. A UK study even found that losing even produces a high for gambling addicts.
If people lose a bunch and that lowers their expectations, that will increase how happy they are when they finally do win.
Now, in other words, if 2 bad things happen in a row, your expectations of a potential good outcome are gonna be reduced. But if 1 good thing happens after that, you're gonna end up happier even though you're still in the negative. Many studies have found that the brains of speculators and gamblers have very similar cognitive and personality profiles. They share traits like being overconfident in their investment skills. They love confirmation biases, so they consume this content that just reinforces what they agree with and avoid watching content that doesn't. And there's a gravitation towards these lottery-type stocks, i.e. stocks with a low price, but with a small chance of increasing many multiples of their current value. Looking at you, meme coins. And arrive, of course, at the epitome of this thing, which is Polymarket, a platform where you can bet on everything. Is the recent ceasefire ending by a certain date? Release date for the next GPT? How many tweets will Elon post this week? And of course, who wins the election? These aren't silly side bets. There are at least 10 of these with a volume of over $1 million, some in the hundreds of millions of dollars. A guy who bet on Trump winning the election made $85 million. And this is a US company, of course, although it's banned from use in the US. I mean, just like the sports books.
A 20-year-old Robinhood trader took his own life.
His Robinhood account showed a negative balance of more than $700,000.
Tragedy is that he didn't owe that much or even anything close to it.
How was a 20-year-old with no income able to get assigned almost $1 million worth of leverage, he wrote?
Okay, but why? Like, what makes the US different and so heavily addicted to this risk? Many years of US history, from financial downtowns to massive fraud scandals, have made America distrust the system and their government. This creates this burning need to ignore conventions, to ignore the rules and education, and to make decisions by yourself, to play the market instead of getting played by the market. Ironically, though, financial literacy in the US is much lower compared to that of the UK, and because there isn't a centralized personal finance curriculum, a lot of learning just happens informally. The entrepreneurial, the American dream hustle and competitive money-making culture is key to this. As a startup founder, I started a company, which means there's a 90% chance that this company will fail. And that makes me kind of part of this statistic, in a way. But most people either don't have the possibilities or the idea or a team or the time to start their own business. So they choose easier, lower effort options to try and get ahead. But getting ahead is oftentimes motivated not by greed, but by need. 44% of millennials in the US already have more than one job to try and make ends meet. They're struggling more than any other generation before them to own a house. Many have run the math and understand that unless something drastic changes about their money, they'll never be able to afford one. Add to that college debt, the most expensive healthcare system in the world, and this self-funded retirement system. How do you get ahead? The safety nets in many European countries, and even for example in Japan, means that there's a lesser need to think outside the box, to risk money to make money. And that does dampen the entrepreneurial spirit in these countries, but it also translates into an overall better quality of life. I'm not here to solve America's problems, but I'm here at least to shed some light for you into the parallels between these two, and hopefully convince a couple people not to YOLO their life savings on GME or on the next influencer meme coin. Now, if you enjoyed this video, you should check out our video on how money gets made and why 92% of money that we use today doesn't even exist. Catch you on the next one.